November 15th, 2024. We had a big gap down and a bear channel. And the thing to keep in mind, or I guess you could say it was a big bear trend. The thing to keep in mind is when you get a gap down, you have to be expecting a second leg from the gap. It's natural when you get a gap down to mentally think to yourself, we're really far away from the average price, which is the moving average. And so we should pull back to the moving average. But the reality is, gaps down, if you think of them as big spikes, you know they need second legs. So instead of looking to buy anywhere down here, you should probably be looking to sell. Bar one, a bear bar closing near its low. Good for the bears after the gap down. Whenever you get a gap down and a bear bar closing near its low, there's a chance it's the high of the day. This used to be when I first started trading. It was my favorite kind of trade to take a sell like below one, but the reality is it's pretty low probability. So if you did sell below one, good job. Assuming I would imagine you held through most of the day, but that's pretty much the only way you can profitably sell below bar one is you take the sell every time it happens, and the 20% of the time, maybe 25% of the time that it turns into a big bear trend, you end up cashing in, and it makes up for all the losses that you take along the way. Bar two, disappointing bar, so a big doji bar. Probably buyers not too far below, probably sellers not too far below above. If you sold below one and you were disappointed with two, you might buy back your shorts during three. So you can see disappointment on two. Bears who sold below one, a lot of them bought back their shorts, and that causes the bounce on three. Anyone who held through two and three, you can see, was interested in buying back their shorts, and that's part of what caused four to be a big bull bar. Bears giving up on the idea of a quick bear trend from the open. A lot of traders, if they're selling like a bar below one, they're expecting essentially a collapse below one on two, three, and four. And if you don't get it pretty quickly, a lot of them will bail out of the trade, and that's what's happening here. Do you buy above four? I probably wouldn't. It is a big enough bar that it should get the second leg. However, you have to keep in mind we still need a second leg down from the gap, so we're probably still always in short. I think you can make an argument. The last time the market was always in long was here. Yet, we definitely weren't always in long with any of this. I'm sorry, it's super zoomed out, but you can look on your own chart from basically bar 54 on Wednesday. We weren't really always in long here. We didn't really go always in long yesterday. And today, until pretty much the end of the day, we didn't really go always in long. But if you could argue the bigger picture that this rally is just a pullback from this, and we're probably going to get a second leg down from the entire parabolic move down, or not necessarily parabolic, from the entire move down. It might just end up being a 50% pullback, and then we go back down. Five, a bear bar closing near its low. Good for the bears. Could sell below, expecting that we're going to get, a possible second leg down and possibly a measured move down. But it's definitely a swing trade, and you're taking a chance that we've seen the low of the day, or the high of the day, and I'm not all that convinced that we have at this point. So again, if you sell below five, it's lower probability. Probably better to wait to see if you get follow through, 6, 7, something like that. But you could take a swing sell below five, neckline of the double top, the bar too low. 6, follow through for the bears, consecutive bear bars closing near their lows. 7, another bear bar closing near its low. So at this point, you have a first leg, 5, 6, 7. You can just sell the close and expect the measure move down. I did not do that today because I don't usually sell this far below the moving average, so I ended up hesitating. So really, I only did, I sold the close of 52 today and exited above 54, and then I bought the high of 62 during 65, and I exited above 64. So I bought here during that bar, and then I exited up here. And really, it's not a very hard limit order trade because 63 needs the second leg. But I don't know. I don't think I should be taking very many limit order trades. But I think the best trade of the day is just sell the close of 7 or 8, and you just hold. Think about it. What's the first reversal up going to look like? It's going to be minor. This is a perfect example of a day where you could just sell, and we never touched and just hold until we touched the moving average. And you could have very feasibly sold the close of 7 or 8 and held until we got to bar 63 and just exited above that. So 7, another bear bar after 3 straight, 5, 6, 7. 8, another bear bar. Good for the bears. We're going lower. We have 2 open gaps. The question is really just, do we get a pullback, and how does the pullback look? But anyways, really large spike down, 5, 6, 7, 8, and expect them to move in general, which is where we ended up going. 9, a pullback, but if you sold for any reason and you exited, if anyone is watching this, you sold for any reason and exited above 9, why did you exit above 9? Would you ever buy above 9 and expect to make money? No. So there's really no reason to exit above it. You're just scaring yourself out of a good trade. Sellers above 9, you know that. So sellers above 9 during 10, outside down bar. 11, a bear bar, closing decently, probably going to get at least a second leg sideways to down from 10 and 11. And the whole move from 5 through 8 is going to get a second leg down if we do pull back. 12, an inside bar, a low one short. Buyers below 12, at least initially during 13, but we're always in short. So you're not going to be buying below 12. You should be trading with the always in direction, which is pretty clearly always in short here. 14, or 13, another bull bar, like I said. 14, a bear bar, but a large tail. So initially buyers below 12, scaling and lower. 15, a bull bar. Basically just 4 straight doji bars. Not much to do here. Disappointment. 16, another doji bar. Big outside down. 17. Really, again, it's just looking like it's starting to go sideways after a strong move down. And if it does start to go sideways, you can pretty clear spike from 5 to 8, pull back 9, and now we're in a bear channel. So spike, pullback, channel, and we ended up channeling all the way down. And then what is this? This is the start of the trading range. So where is the start of the trading range going to go up to? Well, it could go up to the top of this part of the bear channel, since it tried to convert into a trading range here, failed, and got a new spike pullback channel. So you could argue the top of the channel here is the reason why we went here, or you could say we might go all the way up here, maybe on Monday. 18, a bear bar, but a large tail on the bottom, buyers below. 19, an inside bar, a low one short, but not really that great. Huge tail on 17, so pretty wide stop. 20, a bear bar, but sellers above 19, scaling and higher. 21, a bull bar, a large tail, so initially got bought up, bears buying back shorts, but traders sold the market, betting we're not going to cross the moving average. 22, another bull bar, 3 straight bull bars, but we're below the EMA. I would not sell, or I would not buy any of this stuff in here until we get a reversal above the EMA. So for me, I think once you see this, once you see 5 through 8, any buy is a mistake until we cross the moving average. So once you see this, your brain should just switch immediately to sell mode, and you should not buy anything unless we cross the moving average first. Because after you've gotten 20, 30, 40 bars below the moving average, it doesn't really make sense to be taking that kind of trade. 1 second. Okay. 23, an inside bar, a high one buy, but probably sellers above the high one, scaling in higher. 24, a bull bar, just looks like a second leg up. 20 through 22, first leg pullback. 23, second leg 24, 25, bear bar closing near its low. Possible head and shoulders 12, 17, 24, but bear bar closing near its low after a pullback, still always in short, solid close. 26, follow through. If you wanted to wait for follow through, that's fine. Solid close 26. More follow through 27, but a large tail on the bottom. You can see buyers at the new low. So we're possibly forming a wedge, but it doesn't really matter. It doesn't, the wedge is not really all that good. 28, a bull bar, but a large tail on the top. There were sellers above 27 during 28, at least initially. 29, an inside bar, a high one buy for the bulls, a low one short for the bears. We're still probably going at least a little bit lower. 30, a bear bar, a large tail on the bottom. So probably not too much lower, but again, still always in short. There's really no reason to do anything except short. So you can just sell at the close of any bear bar for any reason, and you don't really need to exit. So the thing is, once you become convinced it's a trend day, and it was pretty obvious, I think the signs that you look for a trend day are 2 early open gaps. Sorry, excuse me. 2 early open gaps and a strong move and not crossing the moving average. So you can have kind of an invincible mentality towards the reversals, where if you sell any of these closes, it's really strong. You have gaps. A bear trend day is possible. Just don't exit until we go above the moving average, and you'll probably end up holding for much longer than you would have ever expected. So 30, these are all minor reversals. So 30, 33, a bull bar closing somewhat near its high. It probably needs a second leg up. 34, follow through. You can see a lot of the bears who sold the close of 32, disappointed 33, using 34 to buy back their shorts. Doji bar 34, bear bar closing near its low 35, and then follow through 36, 37, 38. I can go through all of these patterns. I could go bar by bar and just do that whole thing, but reality is there's nothing to buy. Just do not buy on a bear trend day until we cross the moving average, and do not sell on a bull trend day until we cross the moving average. So that's something you should just drill into your head is that, the moment we get the move like 5 through 8, or, if you start to suspect it could be a trend day in either direction, just do not trade in the opposite direction until you get, a bounce. And you could sell any bar for any reason. It's always going to feel like you're selling really low. And sometimes you are just going to sell below. That's kind of part of the deal. If you want to be a day trader, you're going to sell below sometimes, but that's okay. Again, you can just sell and hold until we cross the moving average. And then once we do, you can just get out. So really, and over here, there's not too much to do. This looks a lot more like limit order trading. But for stop order, I'm just going to skip this back piece because it's, again, just sell and hold until we cross the moving average and then exit and probably just be done for the day. For stop orders, you could have sold 5, higher probability, 6, 7, 8, very high probability of another leg down. And you could just hold. You could sell the close below 25 if you wanted to wait for a pullback. You could sell below 26. You could sell above 27, scale in. Sell the close of 30, 31. You could theoretically sell any of these, but getting tighter. Trying to get another breakout to the downside, 51, 52. Still should get a second leg, but not too sure how it's going to look. And then, do you buy 63? I probably would not. The best limit order trade on the day, probably, I don't know, selling above 9, pretty obvious. Selling above 27, maybe a point or two above is pretty obvious. Like I said, I bought here. So I don't know. I thought those were all pretty good. The daily chart, we got obviously a pretty big failure to the moving average, but actually I'm going to use Globex. So pretty big move down through the moving average, but again, it's just a pullback. We could get big up, big down, and then confusion and go sideways. But again, this to me just looks more like a pullback. The weekly chart, big bear bar closing near its low. So this will probably trigger next week, but this is going to get a second leg up. So even if we trigger below here, there'll probably be traders buying below and get a second leg somewhere below at least. And it's the midpoint of the month. So can the bears make this a bear close on the month? Yes, it's 150 points below is the open of the month. So they definitely can, but I'm not so sure that they will. All right, that's going to be it for this